Sure, here's the entire conversation in a copyable box. User, let's talk about trading. Assistant, absolutely. Upward trend, we can talk about stocks, options, forex, crypto, futures, technical analysis, risk management, or trading psychology. If you're getting into trading, I'd suggest we focus on one of these. 1. Day trading, setups, entries, exits, indicators, risk management. 2. Swing trading, holding positions for days to weeks. 3. Options, calls, puts, spreads, IV, Greeks, strategies. 4. Crypto, spot, perpetuals, leverage, market structure. 5. Technical analysis, support, resistance, trends, volume, price action. 6. Building a trading system, rules, backtesting, position sizing, journaling. 7. Trading psychology, FOMO, revenge trading, discipline. 8. Current markets, we can look at what's happening right now and analyze specific assets. If you tell me what you currently trade or want to trade, your time frame, and your experience level, we can get pretty deep into it. User, what is the difference between trading and investing? Assistant, the simplest distinction is time horizon and what you're trying to profit from. Trading, main goal, profit from price movements. Typical time frame, minutes to months. What matters most? Price action, momentum, catalysts, market timing. Activity, frequent buying, selling. Risk, often higher, especially with leverage. Investing, main goal, build wealth from long-term growth. Typical time frame, years to decades. What matters most? Business fundamentals, earnings, valuation, economic growth. Activity, usually buy and hold. Risk, generally lower when diversified and held long-term. A simple example, suppose you buy a company at $100. As a trader, you might think, the stock is breaking resistance and could reach $110 over the next few days. You buy at $100 and plan to sell at $110. Your focus is primarily on the price movement. As an investor, you might think, this company has a strong competitive advantage, growing earnings, and I believe its value will increase substantially over the next decade. You buy at $100 and don't particularly care if it moves to $95 next month. Your focus is on the underlying business and long-term value. The important part, trading isn't simply short-term, and investing isn't simply long-term. There's overlap. For example, someone could hold a trade for 6 months, while an investor might sell a stock after 2 years. The deeper difference is the decision-making framework. Trading, where is the price likely to go, and when? Investing, what is this asset worth, and how might that value grow over time? And neither is automatically better. Trading generally demands more time, discipline, and risk management, while investing tends to rely more heavily on patience, diversification, and staying invested. If you're interested in actually learning trading, we can next break down how a trader decides when to enter, where to put a stop loss, and when to take profit. That's where things get interesting. User, is trading gambling? Assistant, trading can be gambling, but it doesn't have to be. The key difference is whether you have a repeatable edge and manage risk, rather than simply betting on an outcome. When trading becomes gambling, suppose someone says, I think this stock is going up, so I'll put $5,000 into it. They have no defined entry criteria, no stop loss, no position sizing rules, and no idea what their expected return is. They're essentially betting on an uncertain outcome. Other gambling-like behaviors include taking huge positions because you're confident, using excessive leverage, trying to win back losses immediately, trading based on tips, rumors, or emotions, increasing your position after losing simply to make it back, having no tested strategy or statistical edge. When trading is different, a disciplined trader might instead have rules like setup, buy only when conditions A, B, and C occur. Entry, $100. Stop, $97. Target, $109. Risk, 1% of account. Expected win rate, approximately 45%. Average winner, 3R. Average loser, 1R. Here, individual trades are still uncertain. You cannot know which trade will win. But if the strategy has a positive expectancy over a large sample, you're no longer relying purely on luck. You're managing a probabilistic system. For example, with a 45% win rate. 0.45 times 3R minus 0.55 times 1R equals plus 0.80R. That's a theoretical positive expectancy before considering fees, slippage, and other real-world effects. The interesting part, even professional trading has an element of uncertainty. A good trader can lose 10 trades in a row. A bad trader can get lucky and make money for several weeks. So, one winning trade does not equal good trading. One losing trade does not equal bad trading. What matters is whether your process has a demonstrable edge over many trades and whether your risk of ruin is controlled. That's actually one of the biggest differences between a trader and a gambler. A gambler focuses on the outcome of the next bet. A trader should focus on the quality of the process over a large sample of trades. User: my strategy for trading is to combine scalping stocks, holding onto monthly dividend stocks, and the dividend capture strategy. It depends on what will make me more money. Is that gambling? Assistant: not necessarily. What you described is a combination of trading and investing, and it becomes gambling mainly if you're choosing between them based on intuition or chasing whatever seems likely to make the most money right now. Scalping stocks, right pointing arrow trading. You're trying to profit from short-term price movements. Holding monthly dividend stocks, right pointing arrow investing. You're primarily seeking income and long-term appreciation. Dividend capture, right pointing arrow trading. You're trying to profit from receiving a dividend while managing the stock price movement around the ex-dividend date. The important question is how you decide which strategy to use. If your approach is, I'll scalp when I see a high probability setup, hold dividend stocks when the fundamentals and yield make sense, and use dividend capture only when the expected return justifies the risks and transaction costs. That's not inherently gambling. It's a multi-strategy approach. But if it's, I'll do whichever one I think will make the most money this week, that starts getting much closer to gambling, because you're potentially switching strategies based on emotion and short-term outcomes rather than evidence. One thing I'd be particularly careful about. Dividend capture isn't free money. If a stock is trading at $50 and pays a $1 dividend, the stock can theoretically fall by roughly $1 when it goes ex-dividend. Taxes, bid-ask spreads, commissions where applicable, and price movement can make the strategy unattractive. The fact that you receive a dividend doesn't automatically mean you've made money. So I'd evaluate each of your three approaches separately. Scalping. Does my setup have positive expectancy after fees and slippage? Dividend investing. Is the company financially strong enough that I want to own it even if the stock drops 20%? Dividend capture. After the expected price adjustment, taxes, costs, and probability of adverse movement, is there actually an edge? If you can answer those questions with rules and data rather than feelings, I'd call what you're doing speculative trading, investing, not simply gambling. Are there any success stories in trading or investing? Absolutely. And there are some remarkable ones. The important thing is that most of the legitimate success stories aren't really, I bought a stock and got rich overnight. They're stories of being right about a business and staying invested long enough for the compounding to matter. 1. Warren Buffett, turning investments into a fortune. Warren Buffett is probably the classic example. Through Berkshire Hathaway, Buffett bought businesses and stocks he believed were undervalued and held them for years or decades. Berkshire's own records show some extraordinary years. For example, its per-share market value rose 129.3% in 1976, 102.5% in 1979, 93.7% in 1985, and 84.6% in 1989. There were also terrible years, including -48.7% in 1974. B. Berkshire Hathaway. +1. That's actually a great illustration of the point from your previous question. Even one of the greatest investors in history experienced enormous losses along the way. 2. Peter Lynch, finding ordinary companies that became extraordinary. Peter Lynch ran Fidelity Magellan for many years and became famous for finding companies that other investors overlooked. His approach was essentially, look around at businesses you encounter in everyday life, investigate them, and understand what you're buying. Magellan's long-term record remains impressive. Fidelity currently reports a 15.70% annualized return since the fund's 1963 inception, though that figure covers periods well beyond Lynch's tenure. F. Fidelity Fund Research. +1. Lynch's career is an interesting example because he wasn't trying to predict tomorrow's stock price. He was trying to identify good businesses before the broader market fully recognized them. 3. Nvidia, the kind of individual stock winner people dream about. This is a more recent example. Someone who bought Nvidia very early and held through its enormous growth could have made an astonishing return. NVIDIA's historical data shows annual gains such as 2001, plus 346.9%, 2016, plus 232.9%, 2023, plus 246.1%, 2024, plus 178.9%. But here's the part that gets left out of the success stories. Nvidia also fell 82.9% in 2002 and 75.6% in 2008. C. Company's market cap. So imagine buying it, watching your investment explode upward, and then watching most of it disappear during a crash. The person who became wealthy wasn't necessarily the person who avoided the crashes, it could be the person who understood what they owned and didn't panic sell. 4. The really interesting success story, regular people. This is the one I think is most relevant to you. You don't have to discover the next Nvidia. Suppose someone steadily bought a diversified stock market fund for decades. They might experience $10,000 right pointing arrow, $8,000 right pointing arrow, $12,000 right pointing arrow, $9,000 right pointing arrow, $15,000 right pointing arrow, $25,000 right pointing arrow, $40,000 right pointing arrow, $75,000 right pointing arrow, $150,000. The path isn't smooth. There can be years where the account looks terrible. But when you combine regular contributions plus time plus compounding, the result can become surprisingly large. And that's why I wouldn't frame stock investing as put your money in the market and hope it doesn't disappear. I'd frame it as own productive businesses, diversify your risk, give yourself a long time horizon, and don't let temporary price declines force you into permanent losses. There is a huge difference between trading stocks and investing in stocks, too. If you're interested, I can show you 5 real examples of people who turned relatively small amounts, $1,000, $10,000, into much larger sums through stocks, including what they bought and how long they held it. B. F. C. Sources. User. What is a P&L sheet? ChatGPT. A P&L sheet means profit and loss statement, also called an income statement. It shows how much money a business earned, spent, and ultimately made or lost over a specific period. The basic formula is revenue minus expenses equals profit or loss. Simple example. P&L item amount. Sales revenue $100,000. Cost of goods services minus $40,000. Gross profit $60,000. Rent minus $10,000. Salaries minus $25,000. Marketing minus $5,000. Other expenses minus $3,000. Net profit $17,000. So in this example, the business brought in $100,000, spent $83,000, and had $17,000 in profit. What a P&L tells you. Revenue. How much the business sold. Cost of goods sold (COGS), what it cost to provide those goods, services. Gross profit. Revenue minus direct costs. Operating expenses, salaries, rent, advertising, software, etc. Operating profit, profit from normal business operations. Net profit, what's left after all expenses, interest, and taxes. One important distinction, a P&L is not the same as a bank account statement. A business can show a profit on its P&L while having relatively little cash available, because accounting profit and actual cash flow aren't always the same. User. When it comes to trading, do you pay attention to open P&L or today's P&L? ChatGPT. If you're talking about a trading account, I'd pay attention to both, but they answer different questions. Open P&L equals how much you're currently up or down on positions you still hold. This is the more important number for deciding how your current trades are performing. Today's P&L equals how much your account has gained or lost during the current trading day, including realized and/or unrealized changes depending on your broker. Example. Suppose you bought a stock yesterday for $100 and it's now $110. Open P&L, plus $10. Today's P&L, potentially plus $10 if it was $100 at today's open. But if you bought it at $100, it closed yesterday at $108, and today it's $110. Open P&L, plus $10. Today's P&L, plus $2. So if you're asking, am I making or losing money on this trade, look at open P&L. If you're asking, how did I do today, look at today's P&L. One caution, brokers calculate these slightly differently, especially around commissions, overnight positions, deposits withdrawals, and market open. User, so if one is in the negative and one is in the positive, do you lose money or gain money? ChatGPT, it depends on which one is positive and which one is negative, but if you're asking whether your overall account is actually making money, the key number is your total account value, equity, not simply today's P&L. For example, open P&L, $500 right pointing arrow your currently held trades are down $500 from what you paid. Today's P&L, plus $200 right pointing arrow your account is up $200 compared with the start of today. That means you are still down $500 on those open positions, but you gained $200 today. So, open P&L equals performance of your open trades. Today's P&L equals performance for today. And importantly, a negative open P&L doesn't necessarily mean you've permanently lost that money. It's an unrealized loss until you sell, though the position could continue falling. User, how can you tell if you made money? ChatGPT, the simplest way is to look at your account balance, equity, but for a specific trade, look at your realized P&L. If you have not sold the stock, look at open P&L. Plus $500 right pointing arrow you're currently up $500. $500 right pointing arrow you're currently down $500. That gain, loss is unrealized because you still own the stock. If you have sold the stock, look at realized P&L. Plus $500 realized right pointing arrow you actually made $500 on the trade. $500 realized right pointing arrow you actually lost $500 on the trade. To know whether you're actually growing your account, compare your current account equity with what you originally put in, while accounting for any deposits withdrawals. For example, you deposited $5,000 right pointing arrow account is now $5,700 right pointing arrow you've made about $700, assuming there were no additional deposits withdrawals. Today's P&L isn't the same thing as your overall profit. It only tells you how you did during today's trading session. User, if you sold the stock, which one matters? ChatGPT, if you sold the stock, the number that matters for that particular trade is your realized P&L. Realized P&L positive right pointing arrow you made money. Realized P&L negative right pointing arrow you lost money. Open P&L right pointing arrow no longer matters for that position because you don't own it anymore. Today's P&L right pointing arrow tells you how your whole account did today, not necessarily how much you made on that particular trade. Example, you bought for $1,000 and sold for $1,200. Realized P&L equals plus $200 right pointing arrow you made $200 before any applicable fees, taxes. So if you're looking at your trading screen after you've sold, look for realized P&L or your trade order history to see whether that trade made or lost money. User, what if there is no track of realized P&L? ChatGPT, if your platform doesn't show realized P&L, you can calculate it yourself. For a simple stock trade, sale proceeds minus purchase cost minus fees equals profit loss. Example, bought 10 shares at $50 equals $500. Sold 10 shares at $60 equals $600. Fees equals $5. $600 minus $500 minus $5 equals $95 profit. So you made $95. If you're looking at your account after selling. Another simple way is to compare your cash account value before and after the trade, while accounting for any other deposits, withdrawals, or trades you made. If your platform doesn't show realized P&L, you can use your trade history, transaction history to determine the purchase price, sale price, number of shares, and fees, then calculate the profit or loss yourself.